In this video, we'll examine two key takeaways from Chris Mayer's fascinating book 100 Baggers to discover what it takes to uncover one. Staying focused throughout this video is essential because having a tiny percentage of your portfolio in only a single 100 bagger can significantly help you build a fortune. Interestingly, the average stock in Mayer's research compounded at over 21% yearly for 25 years to hit the 100 bagger level. While other great investors like Peter Lynch looked for 10 baggers, Mayer focuses on far more significant 100 times returns. Some examples mentioned in the book that achieved 100 times returns are Amazon, General Finance, and Lowe's. Key takeaway 1. Essential metrics. Ideally, look for smaller cap stocks with lower multiples and economic moats to find the best stocks. Focus primarily on earnings, price-to-earnings ratio or PE ratio, return on equity or ROE, return on assets or ROA, and return on capital or ROC. We want the ROE to be over 15% for over 5 years via high profit margins and without much leverage. Sales growth should also be over 10% for more than 5 years. The book mentions that you should not worry much about market timing and look more into filtering your stock search to find strong fundamental metrics. Before a stock hits 100 times its price, the median sales is around $170 million, and the median market cap is around $500 million. Knowing this information helps give you an idea of the type and size of companies we're searching for. According to this information, the PS would be around 3, which is not considered cheap. Last but not least, we want to see high insider ownership, ideally over 10%, which is not uncommon for smaller cap stocks. Large insider ownership usually means management believes the company will do well, and the price is normally discounted because it's not liquid enough to be in an ETF. Key takeaway 2. Key factors. A fascinating study by an Indian brokerage called Motilal Oswal looked at 100 baggers in the Indian stock market. The study found that there are 5 key factors to look at to make a 100 bagger. The size should be small. The median market cap in their study was around $500 million, with median sales around $170 million. Growth should be high, especially in terms of earnings, high-quality management, longevity and quality in growth. Look beyond reported earnings and focus more on potential sales growth. Companies such as Netflix and Amazon sacrificed profit in the short run to reinvest and gain market share so they could make more profit in the long run. The price should be suitable for high returns. The average price-to-sales ratio in Oswal's study was 3. They realized that a company's management is the most important factor for a 100 times return. Those who master the ability to find excellent management are far more likely to be rewarded by the stock market. Surprisingly, they found out that most of the 100 baggers were not cheap based on their financial results. Instead, you must look to the future because if you look at past results, other investors would likely buy the stock, which would be priced according to the performance. We've looked at reasons to buy. However, how about knowing when to sell? The book mentions significant reasons to sell that include when there are better investment opportunities or if the stock has reached its intrinsic price. The investment thesis turns out to be off your targets. According to investing legend Charlie Munger, if a business makes 5% per year over 30 years, you'll likely make around 5%. However, if you find a company that produces 15% per year over only 10 years and do not buy it at a huge discount, you'll probably end up making around 15% per year. It sounds obvious, but not many investors actually think like this. We can look at stock buybacks as an essential factor only if the stock is below its intrinsic value. According to Warren Buffett's letter to Berkshire Hathaway shareholders, if a high-quality company is selling for below intrinsic value and retained earnings are used to buy back shares, then that's a great sign. Warren Buffett is famous for finding a moat in businesses with high gross margins and a clear competitive advantage. Gross margins often stay relatively similar over the long term, which is important in finding a potential moat. Additionally, we want to look at how and where a company adds value, and whether that competitive edge is sustainable over the long term. Here is a list of the most important points from the book. Lower multiples are better. Also, you ideally want companies that pay low or no dividends as they can instead reinvest their profit into growth. Moats are vital. The best ideas are often the simplest, and should ideally have the potential to expand globally. Smaller companies are preferred as they are more likely to yield higher returns. Focus on looking at companies under the $1 billion market cap. Invest for the long term. stop looking at stock prices every day. Unless your long-term analysis changes significantly, you should hold on to the stock through periods of underperformance. Management is crucial, especially for smaller companies. Ideally, they should be able to allocate capital efficiently and take part in share buybacks to boost shareholder returns. High growth is vital. It's better to find a stock with 30% growth and a 30 PE ratio than a 10% growth and a 10 PE ratio. The logic behind this is that the power of compounding over the long term means that long-term growth is likely to be more significant than current earnings. Apply a filter to find key metrics for the industry. Using a stock filter tool such as the one in the video description box helps narrow your search. Management is key. Ideally, look for owner-operator companies such as, according to Mayer, they often outperform other companies. You may wonder why. The reason is that founder-led companies have more skin in the game and often have more determination to make their creation succeed. He mentions using the PEG ratio to enhance the PE ratio by including expected earnings into the equation. The ratio is calculated by looking at the price divided by the earnings per share divided by earnings per share growth. The PEG ratio is simply another indicator used to find a stock's value, and a lower PEG may mean that a company is undervalued. Beware though, because the PEG ratio can differ between sources, so make sure you do your own calculation to find a reliable answer. The difference between sources is due to some equations using a 1-year growth estimate, while others may use a 3-year estimate. Ideally, we want to see a PEG less than 1, which means that a stock is more likely to be undervalued. Finding a 100-bagger is not easy, as you must have great filters. If you would like to find out how the great investor Warren Buffett filters and analyzes stocks, make sure you check out this video here. To help you filter for 100-baggers, you can use this as a general guide to build from. Sales growth over 15%. Market cap of less than $500 million. EPS growth of over 15%. PEG below 1. Insider ownership over 20%. Average ROE over the last 5 years over 20%. Remember that while some 100-baggers may take less than a decade, most will take 20 to 25 years to reach that level. Also, it's important to not compare the performance of your 100-bagger stock to the S&P 500 because the performance of your stock will likely be more volatile. Additionally, don't pay too much attention to macro market conditions, as this is difficult to predict. The book is highly recommended as it has helped me find some great investments. The techniques and tips mentioned help form a solid foundation for investing. Check out this video for more tips on how to find large gains from stocks, according to Warren Buffett. Also, please consider subscribing and clicking that like button because it helps. Cheers!